Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So in today's session, we are going to discuss a very important report of the Reserve Bank of India, that is the Financial Stability Report, June 2026 edition, which is very important for your Phase 2 examination for the RBI Grade B. Okay. So from the descriptive perspective as well as from the objective perspective, this financial stability report is going to be very important from the examination perspective. So first of all, give me a thumbs up if I'm clearly audible and the screen is clearly visible. Okay, everything seems fine from my end. So this report, this is the half-yearly report of the Reserve Bank of India. It is released as the June 2026 edition, and then the December 2026 edition will be released later on. Now June 2026, this is released, and now as the examination is in July itself. So this report, this edition is very important, and from the financial stability report, previously also there was a question in the RBI Grade B Phase 2 descriptive part. Okay, so it's not like that never the question has come from the FSR in the descriptive part. It has in the 2022-23 there was a question. In 2022 there was a question from the FSR, or in the previous years there was the question from the FSR in the descriptive part of the examination. Okay, so the FSR report from the objective perspective, from the descriptive perspective, this report is very important. We will discuss the important points which will help you from the descriptive as well as objective point of view, as well as we will discuss the important facts from this report. Okay, so this is your detailed coverage for the financial stability report June 2026. Let's get started. Okay, now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so the PDF of the session, it will be provided to you in the Telegram channel of EduTap. Okay, and the link for the Telegram channel is provided in the description box below. Now let's start with the RBI has released the financial stability report June 2026. So let's start with this FSR June 2026 edition. So RBI released the June 2026 issue of the Financial Stability Report, which reflects the collective assessment of the subcommittee of the Financial Stability and Development Council on the resilience of the Indian financial system and risk to financial stability. So this Financial Stability Report, it is the collective assessment. So this report, it reflects the collective assessment of the subcommittee of the Financial Stability and Development Council. So first of all, the Financial Stability and Development Council, it was constituted in 2010. The council is chaired by the Union Finance Minister. The Financial Stability and Development Council has the members, that is the Governor of the Reserve Bank of India, Chairman of SEBI, Chairman of PFRDA, Chairman of IRDI, the Chief Economic Advisor. Okay, such kind of important people, the Finance Secretary, the Secretary of the Department of Economic Affairs. Such important people are members of the Financial Stability and Development Council. The Union Finance Minister is the chairman of the Financial Stability and Development Council, Governor of RBI, Chairman of SEBI, Chairman of PFRDA, Chairman of IRDI, the Chief Economic Advisor. These people are the members of the Financial Stability and Development Council. Now the Financial Stability and Development Council, it has a subcommittee. That is the subcommittee of the FSDC. Now the head of the subcommittee of FSDC is the Governor of the Reserve Bank of India. So RBI Governor is the head of the subcommittee of FSDC, and the other members like the Chairman of SEBI, Chairman of PFRDA, Chairman of IRDI, Chief Economic Advisors and such, they are also the members of the subcommittee of FSDC. Now this Financial Stability Report, this reflects the collective assessment that is provided by the subcommittee of the FSDC, by the different regulators, by the different important areas, okay, from the different important areas on the resilience of the Indian financial system. So our Indian financial system, it consists of the banking system, the financial markets, the insurance system, the pension system and such. So the Financial Stability Report, it shows us the resilience, or it provides the idea regarding the resilience of the Indian financial system and the risk to the financial stability. Okay, so here I hope this is clear that the FSR, the Financial Stability Report, it reflects the collective assessment of the subcommittee of the FSDC, and the subcommittee of the FSDC is chaired by the Governor of the RBI. The FSDC is chaired by the Union Finance Minister, while the subcommittee of FSDC, it is chaired by the RBI Governor. Now this FSR, it provides us the clarity about the resilience of the Indian financial system and the risk to the financial stability. So now FSR is a half-yearly publication which is released for June as well as for December. It reflects a collective assessment of the subcommittee of the FSDC with inputs from all the financial sector regulators, from the SEBI, from the IRDI, PFRDA, from the RBI also. It shows the assessment and evaluation of the subcommittee of FSDC on risk to the financial stability and the resilience of the financial system. So this we will understand that what are the risks to the financial stability and what is the resilience of the financial system of our country as well as at the global level. FSR consists of 3 chapters: the macrofinancial risk, financial institutions, soundness and resilience, and the regulatory initiatives in the financial sector. Now all these chapters are important because a question can come that FSR has given the overview regarding the, or the FSR has given the data regarding the macrofinancial risk. The FSR has informed about the financial institution soundness and resilience and the regulatory initiatives in the financial sector. Describe. Okay, so from all the chapters, like previously also such kind of question has come, like from the report on currency and finance, that from all the chapters, like there were the name of the chapters were given and you had to give the information about the chapter. Similarly, a question can come here also that FSR, these are the 3 chapters and you have to inform about that. Okay, chalo. Now we are starting with the chapter 1, that is macro financial risk. And currently the most important problem at the global level is what? At the global level, the many countries are facing the fuel price increase, or they are facing the energy price increase, or there is the supply chain disruptions that are coming at the global level. Many countries are facing it. So why is it so? Because of the West Asia conflict, because of the US Israel versus Iran situation that is going on. Okay, so global financial conditions tightened following the outbreak of the West Asia conflict. This we will be able to understand better when we go through the data points or when we go through the details given in this chapter. So we are starting with the chapter 1 and we are starting with the global economy. Now in this chapter, there is the details about the global economy and the situation of the global economy, as well as the macro financial risk for the domestic economy and the situation of the domestic economy. So let's start with the global economy first. Okay, West Asia conflict poses significant challenges to both the global and the domestic economy through a steep rise in energy prices and other commodity prices like the fertilizers and such, and there is the disruption of global supply chain. The global supply chain has disrupted. Although the interim peace deal, the peace deal that has been signed recently, has mitigated, has reduced the uncertainty. Just give me a second. Has reduced the uncertainty the exact impact will be contingent on the extent. Okay, just give me a second. Just give me a second. Let me resolve this issue. Okay, let's continue this. Okay, although the interim peace deal has mitigated, has reduced the uncertainty, the exact impact will be contingent on the extent and the pace of the supply chain normalization. Okay, so the exact impact will be contingent on the supply chain normalization, that how fast the supply chain normalizes. So this is the idea. So the West Asian conflict, it poses significant challenge to both the global and the domestic economy through a steep rise in energy and the other commodity prices, disruption to global supply chain. Although the interim peace deal, the peace deal that has been signed, has mitigated uncertainty to some extent, the exact impact will be contingent on the extent and pace of the supply chain normalization. Okay. So this is the idea. Okay. So now I think the issue is resolved. Just give me a second. Okay, so sorry for the sudden issue that came. So I hope the first point is clear. Now moving forward with the second one, the global financial system has displayed resilience despite successive shocks. Okay, so the global financial system has displayed that the resilience despite successive shocks that are coming in the recent past because of COVID-19 previously, then there was Russia-Ukraine war, and now there is the situation of the West Asia conflict. Because of the now there is the situation of West Asia conflict. Okay, now because of the West Asia conflict, again the supply chain has disrupted. Before because of the COVID-19 the supply chain was disrupted. Now because of the West Asia conflict the supply chain was disrupted, especially because of the Strait of Hormuz, okay, that has been blocked by Iran. So this is the idea that the global financial system, even after so many of the problems that are coming one after another, the global financial system has displayed resilience despite successive shocks in the recent past. A combination of lower than anticipated rise in oil future price. Now what happened that, see, the oil prices are increasing at the global level. Okay, now it was expected that the oil future prices, the future oil future prices, that is the derivative, like let's say you want to buy oil after 2 months, or let's say you want to buy oil after 3 months or after 4 months. So you are coming into the futures contract, that here today you are deciding a price, or there is a price that has been decided that 1 barrel of oil will be equal to $100. Okay, so this price has been decided, and after 2 months you have to pay the price to get the oil, let's say 100 barrels of oil and such. So this is the oil futures price. That means you are deciding the price right now so that you can purchase it on a future date. So now, lower than anticipated rise in oil future price. There was higher expectations that there will be more increase in the oil future price, but there was lower than anticipated increase that happened in oil future price. Strong corporate earnings, the balance sheet of the corporates are very strong at the global level also, and there is the strong corporate earnings, the AI driven boom and the supportive financial conditions. This has let the financial system at the global level remain resilient. Okay, so the global financial system has displayed resilience despite successive shocks that are coming in the recent past, or that has come in the recent past. A combination of lower than anticipated rise in oil future price, strong corporate earnings, the AI driven boom and the supportive financial conditions has underpinned the market optimism and kept volatility contained. So this is the idea. Okay, now market is pivoting from expectations of rate cut. So another important thing is that the market is shifting away from the expectation of rate cut. In April 2025, in June 2025, in December 2025, there were rate cuts. The repo rate was decreased by the RBI. The RBI decreased the repo rate. Okay, so repo rate was decreased by RBI. Similarly, at the global level, the rate cuts happened. Or there were expectations of the rate cuts, the interest rate to be reduced at the global level. So market is pivoting from such expectation of the rate cuts to future monetary policy path, that is pricing either an extended pause or rate hikes. So in the future, it is expected that either there will be extended pause, that the repo rate will be kept unchanged, or there can be increase in the repo rate, increase in the interest rate at the global level. So market was previously expecting that the rate cuts will happen, rates will be reduced, the interest rates will be reduced, like it happened in India, that in April, June and December 2025 there were rate cuts that happened. The repo rate was reduced, and with that the interest rates started declining in the country. Similarly, at the global level there were expectations of rate cuts as well as now, but what has happened, that there is the expectation that the repo rate, like we use in India, the interest rate in the other countries, or the Fed rates, the monetary authority rates in the other countries will be kept constant, or they can be increased rather than decreasing. Why the rates are increased, the interest rate are increased so that there are less loans that are taken, so that there is less demand. With less loans there will be less demand, and with less demand there will be less inflation in the country. So in the future it is expected that the monetary policy path will be such that the pricing either an extended pause on the interest rate, that the interest rate is kept like that only. The monetary authorities will keep the interest rate at whatever level they are currently, or rate hikes can happen to control the inflation in the country. This could tighten the global financial conditions because the interest rate increasing, at the higher interest rate there will be less loans that will be taken and such, alongside vulnerabilities emanating from rising public debt. The public debt is continuously rising. This is becoming a major problem. There is bond market fragilities that are coming up, that we will discuss in the coming slide also, that the bond market is becoming fragile, it is becoming more volatile, elevated asset valuations and concentrated exposures due to substantial investment in AI. Okay, so there is elevated asset valuation and concentrated exposure. Recently you must have heard that the South Korea, the Taiwan overtook India in terms of the market valuation, stock market valuation. Then South Korea also overtook India in terms of market valuation, stock market valuation. So these countries were able to overtake India in terms of market valuation because of their heavy investment and heavy focus on semiconductor and AI. So there is too much exposure on the AI that is happening currently. Okay, so this is the idea. This is what we have understood about the global economy. West Asia conflict, it has posed significant challenges to both global and domestic economy through steep rise in energy and other commodity prices, disruption to the global supply chain. But recently, because of the interim peace deal, the uncertainty has mitigated. The exact impact that will come depend on that how fast the supply chain normalizes. Okay, how fast the supply chain normalizes. The global financial system has displayed resilience because of the lower than anticipated rise in oil future price, strong corporate earnings, the AI driven boom, supportive financial conditions. These has underpinned market optimism and kept volatility contained. Market is pivoting from expectations of rate cut to the extended pause in the rates or rate hikes. This could tighten the global financial conditions. Alongside this, there are vulnerabilities that are coming up from the rising public debt, bond market fragility, elevated asset valuation, and too much concentration in AI domain. This have become more pronounced. Okay, so this is the idea. Now, coming to the global macro financial vulnerabilities, bond market fragilities. So now, as I've told you that the bond market fragilities, the elevated asset valuation, these are certain problems. So bond market fragility is basically sovereign debt. The government debt already at elevated levels, already at higher levels, continues to increase. And there is the increasing debt servicing cost. The interest rate is also increasing. And so the government debt, the sovereign debt, already at the high levels, they are continuously increasing, and with that their debt servicing cost, the interest rate is also increasing, and with higher government debt they have to pay higher interest. So this is the problem for many of the countries. Over the past 3 years, G4 sovereigns are the USA, UK, Germany, Japan. So over the past 3 years, the G4 sovereigns, they have shortened the average maturity of debt issuance. Basically this means that if the long term loans are taken, for that the higher interest rate has to be paid because there is the long term investment that the investors are doing. So if through the debt instrument, that is for 10 years, 20 years, for that higher interest rate has to be paid because the investor is blocking the money or locking the money for 10-20 years. So for the long term bonds, there is the higher interest that has to be paid. So now the G4 sovereigns, they have shortened the average maturity of their debt instruments ranging between 0.1 to 2.6 years only, amid rising term premiums. Because of the term premiums, long term premiums that are increasing, the interest rate is higher for the long term debt instruments. That's why it has been decided by the G4 sovereigns, or they have recently started taking the funds for the shorter period, so that they have to pay lesser interest rate. As well as what is happening, that the price sensitive investors such as investment funds, foreign investors, households, they now hold at least half of the debt at the global level. So price sensitive investors, they hold a major part of the debt instruments. Okay, so the price sensitive investors, they hold a major part of the debt instruments. Now as soon as the interest rate increases or the bond price decreases, or the interest rate decreases, the bond price increases. So because the investors are price sensitive, so on the basis of the changes in the prices, the investors, they will change their investment patterns also. This can lead to more volatility in the debt market at the global level. So price sensitive investors, they are investing, they now hold at least half of the debt. So that's why there is more volatility, or there is the expectation of volatility in the debt market. Okay, so this is the idea. Now, next is refinancing needs of the OECD. So refinancing needs of the OECD, Organization of Economic Cooperation and Development. So see, basically many of the countries, the OECD countries, let's say they have taken the loan. Now to repay the loan, they need the refinancing. They need the refinancing. Refinancing basically means taking new loans to repay the earlier loans. So refinancing needs of the OECD countries reached a record high of $13.5 trillion in 2025, accounting for around 80% of total borrowing, and are expected to rise further. So that means to repay the loans, there is more funds that are taken. So refinancing needs of the OECD countries has reached a record high of $13.5 trillion in 2025, accounting for around 80% of the total borrowing. This is expected to rise further. So these are the bond market fragilities that you can understand, that the price sensitive investors are involved more now. The average maturity of the debt issuances have shortened. Sovereign debt is continuously increasing the debt servicing costs. Refinancing needs are increasing and such. Now coming to the elevated asset valuation and concentrated exposures. So though the outbreak of West Asia conflict triggered strong initial reactions and corrections, because the valuation, there was higher valuation in many of the markets, in many of the equity markets, in many of the share markets and such. In the share markets, in the equity markets, basically the valuation of many of the companies was very, very high, more than actually the actual valuation should be. Okay, so there was elevated valuation, in many of the countries. There was elevated valuation in many of the countries. Okay, so though the outbreak of the West Asia conflict triggers strong initial reactions and corrections, equity markets in advanced economies and those driving the AI momentum have mostly recovered. Okay, so there were corrections that happened. The asset valuation decreases, the asset value decreases, the stock prices started to decrease. But in advanced economies, because of the AI momentum, the equity markets in advanced economies have mostly recovered. Okay, because of the AI momentum, the equity markets in advanced economies have recovered. But the problem is that the emerging market economies, however, shows sharper corrections in the stock prices, with energy importers witnessing larger adjustment in the asset prices. So this is the problem, that though the outbreak of the West Asia conflict triggered initial corrections, reactions, the equity prices started to decrease, the stock prices started to decrease, but the equity markets in advanced economies have mostly recovered because of the AI momentum. But in the emerging market economies, they show sharper corrections in the stock prices, with energy importers witnessing larger adjustment in prices. So this is the problem that is coming up. Now, the rest of the world's exposure to US equity market has grown too much, with gross foreign holdings of US equities rising to 21 trillion in March 2026, just from 7.5 trillion in March 2020. So just in 5 years, we can say, just in 5-6 years, there is the more than double of the increase that we have seen in the gross foreign holdings of the US equities. Concentration remains elevated, with a small group of firms involved in AI related technologies increasingly driving the stock market performance, that we have seen in the case of Taiwan and South Korea also, that there is the concentration of the investment that is happening in the AI domain. So concentration remains elevated, with a small group of firms involved in AI related technologies increasingly driving the stock market performance in economies that are leading AI adoption or participating in its supply chain. Okay, so this is the idea. Now coming to the domestic macroeconomic conditions. Any confusion anyone has till now? Kindly inform me if there is any confusion anyone is facing. Any confusion? All clear? Chalo. Domestic macroeconomic conditions. So the Indian economy entered the recent bout of the global turbulence triggered by the West Asia conflict with stronger macroeconomic fundamentals. Okay. So during the COVID situation, during the Russia-Ukraine war, India India made its macroeconomic conditions stronger, so that now we are in a better situation. So the Indian economy entered the recent bout of the global turbulence triggered by the West Asia conflict with stronger macroeconomic fundamentals than in many earlier episodes of the external stress. While India's resilience provides an important buffer against these shocks, some impact is inevitable. Even though we have good macroeconomic situation, we have good situation in our country, but the problem is that we have the buffers. See, even if we have the buffers, some impact is inevitable given the country's substantial dependence on the imported energy. So even though we have good macroeconomic fundamentals, we have stronger macroeconomic fundamentals, but still the India's resilience is affected to some level because of the inevitable nature of the India's dependence on imported energy. Okay, so India is somehow affected because of the imported energy. Indian economy recorded a strong growth of 7.7% in 2025-26. That is higher than the average growth of 7.3% in the last 3 years, supported by strong private consumption and fixed investment. Now, elevated oil prices and other commodity prices because of the global supply chain disruption, weaker global growth could adversely affect the India's domestic growth also in 2026-27. Against this backdrop, the Monetary Policy Committee in June 2026 has projected a growth of 6.6% for 2026-27. Okay, so for 2025-26, the growth rate was 7.7%, which is higher than the average growth of 7.3% in the last 3 years. Now for 2026-27, it is expected that the growth rate will be 6.6%. Okay, so this is the projection by the MPC. Several steps undertaken by the government, including support to MSME and export sectors, are expected to help sustain economic activity while reducing the impact of the external shocks. In addition, the interim peace deal that has been signed between US and Iran has laid the foundation for cessation for stopping this conflict, the West Asia conflict, normalization of supply chains, which could provide tailwinds to growth. But again, it depends on how fast the supply chains are normalized. Okay, this we discussed in the global conditions also, that the interim peace deal has been signed, but the effect of this peace deal will be decided on the pace of the supply chain normalization, how fast the supply chain normalizes. Okay, so similarly, the peace deal has been signed and this has laid the foundation of stopping the conflict and the normalization of supply chains, which could provide tailwinds to growth at the global level and at the domestic level also. Next is inflation has remained contained. So inflation has remained contained and below the 4% target. So what is the flexible inflation target? What is the flexible inflation target? The flexible inflation target is 4% plus minus 2%, right? This is the flexible inflation target from March 2026 till from April 2026 till March 2031. The flexible inflation target is 4% within the range of plus minus 2%. So the inflation has remained contained below the 4% target, although it has inched up in the recent months. So previously in many of the months we have seen that the inflation was below the 4% target. Although it has increased slightly in the recent months, the headline inflation rose from 3.5% in April 2026 to 3.9% in May 2026, but it is still below the 4% target, reflecting inter alia an increase in pass-through of oil prices. So now see, the inflation is below the 4% mark. Okay, the inflation is below the 4% mark. So, and it is within the range of plus minus 2%. Minus 2% means 2%. Plus 2% means 6%. Okay, so inflation is within the range of 2% to 6% and it is below 4%. So that is good for our country, that we are able to maintain the inflation within the range of 2% to 6%. Okay, now slowly the inflation is increasing, that we have seen that from 3.5% to 3.9% the inflation has increased. The retail inflation, the headline inflation has increased, reflecting that now there is the pass through of the oil prices, as at the global level the oil prices is increasing. In India also the oil prices is increasing, and now there is the pass through of the oil prices to the customers, and so for the customers the inflation is increasing. Okay, now, however, a combination of conflict. So the inflation has remained below the target, but a combination of conflict-driven supply shock and projected weak monsoon due to the El Nino could push inflation to the higher end of the tolerance band, especially in the Q3 of 2026-27, and worsen the inflation expectation. So basically, the El Nino effect that we can see right now, also the heat waves are going on, the temperatures are rising, the monsoon is delayed. In Mumbai the condition has been seen that the water levels are decreasing, so the El Nino effect can be seen right now also, and El Nino could push inflation to the higher end. With the supply chain disruption that is normalizing right now, the supply chain is normalizing, but it will take some time. So the supply chain disruption, the projected weak monsoon due to El Nino, these could push inflation to the higher end. That means within the range of 2% to 6%, we are on the lower end right now, below 4%, but we can go towards the higher end also. Okay, so accordingly the Monetary Policy Committee revised its inflation projection upwards from 4.6% for 2026-27 to 5.1% for 2026-27. So recently the Monetary Policy Committee has revised its inflation projection to 5.1% for 2026-27. Okay, so but here also you can see that the inflation target is 4%, within the range of 2% to 6%. Still, even with the 5.1% of inflation that is projected in 2026-27, it is below the 6% mark. So that means the inflation will be managed by the monetary authority, by the RBI. The West Asia conflict led to sharp increase in crude oil prices, which could widen India's current account deficit. So in the current account, there is trade in goods, trade in services, and transfer payment, that are the remittances, gifts that we are receiving, or the grants we are receiving and such. Now trade in goods, that means the oil that we are importing, so that is included in the current account. Now because the crude oil prices, now think about it, that we are importing 100 barrels of oil at $100. Now the oil price has increased, now we have to import the 100 barrels of oil at $120 per barrel. So that means $20 extra per barrel we have to pay. $20 extra per barrel we have to pay. For 100 barrels we will have to pay $2,000 extra. $2,000 extra we will have to pay for 100 barrels. So this is the idea. Now we are importing in huge quantities. Okay, so that means we have to pay more. Now. So West Asia conflict led to sharp increase in crude oil prices, which could widen the India's current account deficit, because we have to pay more for our imports. For our imports we have to pay more dollars now. For the oil imports we have to pay more dollars now, okay, because of the increase in crude oil prices. Now gold imports, another key component impacting current account balance. We also import gold a lot. So gold imports, another key component impacting the current account balance, rose significantly in 2025-26, reflecting a steep increase in gold price. Though the gold imports have decreased substantially in March 2026, but in 2025 to 26, it has been seen that there was a steep increase in gold price. Okay. Though the crude oil prices have, however, moderated significantly following the signing of the interim peace deal and should elevate the pressure on the current account deficit, but still during the 2025-26, before the interim peace deal, there were a lot of pressures that India was facing because of the increase in crude oil prices and because of the high gold imports at the higher price, because the gold prices suddenly increased in the 2025-26 financial year. Petroleum and gold together contribute more than half of the trade deficit that we have. So in the current account, the trade in goods, trade in services, and transfer payment. The trade in services and the transfer payment, they are in surplus. But the trade in goods is in deficit, and the surplus in the two trade in services and the transfer payment surplus, they are not able to cover the deficit of the trade in goods. That's why the current account is in deficit. The current account is in deficit. Now, you can understand more than half of the trade deficit, more than half of the trade deficit, it is coming from the petroleum and gold together. So petroleum and gold together contribute more than half of the trade deficit, underscoring trade balance vulnerability to external shocks. Nonetheless, India's current account deficit has remained modest, within the range that we can handle, averaging less than 1% of GDP over the past 3 years. Okay, so this is the idea. Now, domestic economy, external sector. So now coming to the foreign exchange reserves of the, so India has the foreign exchange reserves of US dollar 672.6 billion as on June 19, 2026, cover more than 10 months of merchandise. That is, we have the reserve cover of imports for the goods for 10.3 months of the merchandise exports. For the merchandise imports, we have the import cover of 10.3 months. As well as the foreign exchange reserves, they are able to cover 90.6% of the outstanding external debt. External debt was relatively low at 20.8% of the GDP. So the ratio of external debt to GDP is lower at 20.8% only. While the short-term debt on the residual maturity to the reserve ratio, it was 47.3%. Okay, so the share of the short-term debt, on the residual maturity basis stood at 47.3% of foreign exchange reserves. So this is the idea. Now the capital account has remained. So here the data points are important, that the foreign exchange reserves as on June 19, 2026, US dollars 672.6 billion, the merchandise import cover of 10.3 months, the outstanding external debt that can be covered through the foreign exchange reserves 90.6%, the external debt to GDP ratio 20.8%, the short-term debt to reserve ratio 47.3%. Now the capital account has remained under pressure. The capital account, it includes investments, it includes borrowings, external assistance. Okay, so capital account includes the investments that we are doing in the country, or the other country is doing in our country. So capital account has remained under pressure due to moderating inflows, while gross foreign direct investment were robust in 2025-26. On the back of strong growth prospects, net FDI flows were muted due to rising repatriation. So basically, FDI inflows were good. It was $95 billion. Because of increasing growth of our country, because of the growth expectations of our country, there is more foreign direct investment that is coming. But at the same time, there were more outflows. Okay, repatriation means from the foreign direct investment, that is, the foreigners are opening their subsidiaries, branches, their units in our country. So from the subsidiaries, branches, whatever foreigners are earning, that will be repatriated back to their own country. So let's say a US based company has opened a subsidiary in India. From that, whatever profits are there, the US based company is taking a part of that. So repatriations were higher, as well as the FDI outflows. The investors of our country, they are also investing. They are also, like, the State Bank of India has a subsidiary in other countries, PNB has subsidiaries in other countries and such. So this is the idea, that we get the FDI inflows were strong, but at the same time there were repatriations, rising repatriations, and higher outbound foreign direct investment that happened, due to which the net FDI means the inflows minus the outflows. So inflows were high, but at the same time the outflows were high. That's why the net FDI was muted. The net FDI flows were muted due to rising repatriation and higher outbound FDI. Okay, all clear? Now, next is, alongside this FDI situation, FPI's foreign portfolio investment to India have been under pressure in 2025-26, which intensified after the start of the West Asia conflict. Net external commercial borrowing inflows. So we also borrow from other countries. In that manner, also we get the foreign currency, also moderated significantly in 2025-26. The slowdown has continued in 2026-27 also. The recent measures announced by the government to support the exports and such, as well as the RBI, the swap facility has been provided by RBI. I have recently taken sessions on the swap facility in the Finance 360. So you can see that the RBI is taking the recent steps to mitigate or to reduce the depreciation in rupees by promoting more inflows of the dollar. ठीक है, by promoting or by attracting dollars, like by providing such facilities so that more dollars can flow in the country, the RBI is focusing on reducing the depreciation of rupees. Okay, so the RBI has brought the swap facility for the ECB, also for the external commercial borrowing, for the deposits, for the foreign deposits. The RBI has brought the swap facility, as well as RBI is taking various steps so that the depreciation of rupees can be reduced, as well as more dollars can be attracted in the country, so that we have enough foreign exchange reserves. Chalo, the recent measures have been taken by the government and the RBI are expected to bolster the capital inflows. Therefore, even if the current account deficit widens, even if the trade deficit widens, so stronger capital inflows are likely to mitigate the funding constraint, because in the balance of payment, which records the transactions between India and the rest of the world, there is the current account and there is the capital account. So even though the current account is in deficit because of the trade in goods, because we have to import a lot of oil, gold and such, so even if the trade in goods is in deficit, the current account is in deficit, the good capital inflows can cover the deficit in the current account. So we need good capital inflows, and for that the RBI is taking the steps to attract the external commercial borrowing, to attract the deposits, by providing the facilities to the banks and such. Okay? So recently we have discussed this in the Finance 360. Do see the swap facilities. Chalo. Now coming to the next one, fiscal front. So another key macroeconomic variable that could come under some pressure is the fiscal deficit. The higher prices of the energy. Now the oil prices are increasing, or the LPG prices are increasing. Now the government, it is not passing through all the increase in the oil price. So some of the pressure from the oil price increase is handled by the government. So government has to spend more. The government has to spend more to cover a part of the oil price increase. If the oil price increase happened by 10 rupees, let's say the customers only bear rupees 6. That is, if the oil prices are increasing by 10 rupees, the customers are bearing the 6 rupees increase, while the government is bearing, let's say, 4 rupees increase. So government has to bear a part of the oil price increase. The excise duty has been cut, due to which the government is earning less. Higher outgo on the account of subsidies. The government is providing more subsidies to cover up some cost of the fertilizers and such. So in this manner, the government has to spend more. The government has to spend more for providing higher subsidies, or for providing less pass through of the energy prices to the customers. So the government is spending more. Okay? So this is if the government expenditure increases while the government receipts are not increasing. So you can understand that the fiscal deficit will increase. Fiscal deficit is total expenditure minus total receipts excluding borrowing. So if the expenditure of the government is increasing because of the limited pass through of the oil price increase, excise duty cuts, higher outgo on the account of subsidies, so this leads to higher total expenditure of the government, which increases the fiscal deficit. Okay, increase in custom duty on imports of gold and silver, and on the other hand will provide a fiscal cushion. So there is the increase in custom duty on imports of gold and silver. So the government has increased the custom duty on import of gold and silver. This provides a fiscal cushion. Like the receipts of the government can increase through the custom duty, because the government is receiving more custom duty on the import of gold and silver. Now, financial markets, coming to the financial markets. Any confusion, anyone? So the INR has been under sustained depreciation, rupees depreciating a lot against the dollars over the last several months due to elevated trade uncertainty, weakening of the capital inflows. We are getting less of the capital inflows. That means we are getting less supply of dollars. With less supply of dollars, while the demand of dollars is high only, so there is less supply of dollars while demand of dollars is high. There is the price of dollars that is increasing, value of dollars is increasing against the rupees. So dollar is appreciating while rupee is depreciating. Okay, so INR has been under sustained continuous stress or continuous depreciation over the last several months due to elevated trade uncertainty, weakening of the capital inflows, deteriorating investor sentiments. Recent measures undertaken by the RBI and the government to attract capital flows. So I have told you that RBI has taken the swap facility. RBI has provided the swap facility to attract more capital inflows, to attract more dollars in the country. Okay. So this is the idea. Now with more dollars in the country, there will be the supply of dollars that will increase to meet the demand for dollars so that the depreciation of rupees can stop. RBI took several actions to safeguard exchange rate stability also. To stop this depreciation of rupees or to reduce the depreciation of rupees, RBI has taken various steps, one of which is the net open position in the INR, which has been limited to $100 million only for the authorized dealers. See, the authorized dealers, they buy the dollars, they sell the dollars. Okay, let's say they are buying $1,000 million while they are selling only $200 million. That means they are holding on to $800 million. So tomorrow when the price of dollars increase, when the value of dollars increase, then the banks can sell. Then the authorized dealer banks in India can sell the dollars at the higher value. RBI said you cannot do so. You cannot hold on to the dollars. Supply the dollars. You can only keep $100 million with yourself and you have to supply the rest of the dollars in the market, okay, by the end of the day. So this is on the daily basis. So that means the bank will have to supply $700 million in the market. So supply of dollars will increase in the market, due to which the price of dollars will start decreasing, because as the supply increases, the prices decrease. So that the rupee can stop depreciating. So this is what the RBI said, that the Indian authorized dealer banks, they cannot hold more than $100 million by the end of the day. Okay? So net open position in the INR, this cannot be more than $100 million by the end of the day. Next is money market conditions. So money market, see, if the question comes on the domestic economy, so I have provided you the data points like what are the macroeconomic conditions, the growth. We have discussed about the macroeconomic conditions, the growth condition, as well as the problems, the inflation conditions, the problems, and what is the situation. Then we discuss about the external sector, the foreign exchange reserves, the capital account. We have discussed about the current account also. Okay, then we discussed about the fiscal front, financial markets. Now coming to the money market. Money market is the market under the Reserve Bank of India. So if a descriptive question comes, if a objective question comes directly on the data point, 2025-26, what was the real GDP growth or what was the growth rate? 7.7%. MPC has announced the growth rate for 2026-27, 6.6%. Okay, 6.6%. So these are the data points from which directly the question can come. The inflation growth rate for 2026-27, so 5.1%. So these kind of questions can come. Okay, what is the foreign exchange reserves import cover? 10.3 months. Outstanding external debt cover from the foreign exchange reserves, 90.6%. So these kind of static objective questions can come. Descriptive question can be on the overall domestic economy situation from the various macroeconomic sides, from the external sector, from the fiscal front, from the macroeconomic situation, from the growth, from the inflation side. So in this way, in the point wise manner, I have divided this so that you can answer in this manner. Okay, chalo. So now money market continues to function in an orderly manner, supported by adequate banking system liquidity surplus. Transmission. See, money market continues to function in the orderly manner. This is the market under the regulation of the Reserve Bank of India. Now this is the short-term market where the interbank lending and borrowing can happen. Banks amongst themselves, financial institutions amongst themselves, they can borrow and lend. So money market continues to function in an proper manner, supported by adequate banking system liquidity surplus. Transmission of policy repo rate cut. So I have told you that in April 2025, then in June 2025, then in December 2025, there was the reduction in repo rate. In the 2025-26 financial year, there was repo rate cut. So transmission has happened when the repo rate is decreased, the interest rate decreases in the economy. So the transmission of policy repo rate has been robust at the shorter end of the money market. So in the money market, in the market where the financial institutions are lending amongst themselves, they are transacting among themselves. So transmission of policy repo rate, the decrease in repo rate has been robust at the shorter end of the money market. With the decrease in repo rate, the interest rate in the money market has reduced in the shorter end. While it has been incomplete, that means the monetary policy transmission, with the decrease in repo rate, the interest rate is decreasing for the longer end. In the bond market, like for the let's say 2 months, 3 months, for the longer period of time in the money market, there is still the transmission that is going on, that is with the decrease in the repo rate, the interest rate is still decreasing. But for the shorter period, for the very short period, or for the shorter period, the transmission has been robust. With the immediate decrease in repo rate, there was decrease in interest rate for the shorter end, but with the decrease in repo rate, there is decrease in interest rate that is still going on for the longer period. Okay, the RBI took several measures to supply durable liquidity to provide long-term liquidity in the banking system so that the banks have sufficient liquidity with themselves. Okay, now coming to the next part, if there is any confusion, kindly ask me. See, now total resource mobilization, total resource that was mobilized from the Indian securities market, from the bonds issue, from the share issue. See, the corporates, the financial institutions, they issue the bonds, they issue the shares so that they can collect the money from the investors. They can get the money from the investors. Okay, so total resource mobilization from the Indian securities market in 2025-26 declined marginally, down by 2.3%. The overall decline was largely due to an 8.4% contraction in the debt issuances. So debt issuances reduced by 8.4%, while the equity issuances, that is the share issuances, remained strong, growing by 4.9%. So debt issuances decreased by 8.4%, while the equity issuances, it remained strong, growing by 4.9%. That's it. Now, FPI equity outflows. So foreign portfolio investors, they invest in the financial market of our country. They started selling their share investments, the investment in the equity. So FPI equity outflows, that means the FPIs, they sold the shares that they had invested in, and that's why there was outflows that happened of US dollar 30.7 billion in 2026. This has exceeded the prior record of US dollar 18.9 billion in 2025, marking the highest level observed in the past 2.5 decades. That means in nearly 25 years, the FPI equity outflows was highest in 2026. Long-term institutional investors such as insurers, pension funds, they have gradually diversified a larger share of their portfolios towards equities so that the investment can be continued in the equities, in the shares. While the sharp rise in state government securities issuances, the state governments are issuing the debt instruments, more debt instruments in the recent years, coupled with their relatively higher interest, has led banks to increase their holdings of these securities. So the long-term institutional investors, they are investing in equities so that the money can continuously flow towards the equities also, as the FPIs, they are taking out their funds. So the long-term institutional investors in India, they are flowing the money towards the equities. The sharp rise in state government security issuances with the higher interest rate has led banks to increase their holdings of these securities. Now, asset under management of the domestic mutual fund industry increased to 81.6 lakh crore, recording a 13% year-on-year growth. So asset under management in the mutual funds, this has increased by 13%. Okay, so there is the growth of 13% in the asset under management under the mutual fund. Now coming to the banking sector's health has been constantly improving. Okay. The banking sector's health has been constantly improving over the past several years, thereby strengthening the financial stability. Here you can see that for the scheduled commercial banks, the data has been given that we are going to discuss. Now, CRAR, this is the capital adequacy ratio. It shows that the banks have sufficient capital to handle the distress or not. Okay, so the banks, the scheduled commercial banks, they need to have minimum 9% of the capital against their risk weighted assets, against their risky assets. The banks need to have the minimum 9% of the capital plus 2.5% of the buffers. That means in total 11.5%. But the banks are currently maintaining 17.7% of the buffers. That means the banks are maintaining 17.7% of the capital. That means the banks have sufficient capital. Though the bank's minimum requirement is 11.5%, the banks are maintaining more. So that means the banks are in a very healthy position where the banks have sufficient funds to maintain the good capital to handle the distress. Okay, common equity tier 1 capital, this is the most liquid capital that the banks can handle during the or the banks can use during the time of distress. This is 15.3%. that is very much sufficient, very good. So the banks can handle the distress situation if any comes. Liquidity coverage ratio, this shows the value of high quality liquid assets that the banks have against the net cash outflow that is expected in the coming 30 calendar days. So the depositors are depositing their funds with the banks. Banks lend the funds out from like whatever deposits the bank is getting. The bank uses these deposits to lend the money, to give the loans. Bank keeps some reserves. Now it has LCR shows that what are the expected cash outflows for the next 30 days, that how many of the depositors will come to ask for their money back, what is the expected cash outflow in the coming 30 days. Against that, do the bank has enough of the high quality liquid assets? Do the bank has the cash or the government securities that are liquid enough to be sold in the market? Okay, so LCR shows the liquidity coverage ratio, that means against the outflows, the net outflows that the bank will have in the next 30 days, does the bank have sufficient funds with themselves? So the liquidity coverage ratio is 124.2%. that means against the 100 rupees that is expected cash outflow in the next 30 days, the bank is holding the high quality liquid asset of 124.2, that is higher than what is expected to be the outflow, so that the banks have sufficient funds to give to the depositors. That is the idea. Return on asset, it is basically the returns that the bank is getting 1.3%, that is good. Return on equity, this is the return that the shareholders of the banks are getting, 12.6%, so this is also good. Credit growth is 14.5%. Gross non-performing asset, these are the assets that are not performing, so the loans are the asset for the bank, because on the loans the banks are getting the interest, the banks are earning the interest. So loans are the asset for the bank because on the loan the bank is earning the interest. Now let's say that the interest is not being paid by the borrower. The borrower is also not repaying the principal amount, so that means these are the non-performing asset. These are the assets that are not bringing any returns, or the default has happened. Okay, so gross non-performing assets 1.8%, reduced from the last financial year. Okay, net non-performing asset is basically gross non-performing asset, the total non-performing assets minus the provisions that the bank has to handle the gross non-performing asset. So this is the net non-performing asset. Okay, gross non-performing asset, let's say 100 crores, the provisions that the bank has is 75 crores, so the net non-performing assets will be 25 crores. So net non-performing asset is the gross non-performing asset after deducting the provisions. So this has also reduced to 0.4%. the net non-performing asset is 0.4%. Provisioning coverage ratio, that means against the gross non-performing assets, what are the provisions that the bank is maintaining? So bank is maintaining the provisions of 75.6% against the gross non-performing asset. So banks have sufficient provisions to handle a major chunk of gross non-performing asset. Next is slippage. Slippage means the new non-performing asset, the new loans that have slipped into non-performing asset. So slippage, by this you can understand that the new loans that have slipped into the non-performing asset. So the slippage ratio has reduced to 1.2%. So these are the data points, okay, for the scheduled commercial bank. The CRAR has improved the capital that the bank is maintaining. Common equity tier 1 capital has improved. LCR has decreased, but it is greater than 100%, so that is good. The ROA has decreased slightly. The return on equity has decreased slightly. Credit growth has increased. The gross non-performing asset has decreased, but this is good because the decrease in gross non-performing asset and net non-performing asset shows that there is the improvement in asset quality. Okay, non-performing assets are reducing, that means there is improvement in asset quality. PCR, provisioning coverage ratio, has decreased slightly. Okay, slippage has decreased, so this is also good. Chalo. Now credit to microfinance sector increased for the first time after 7 quarters of decline, but the borrower base continued to shrink down by 22.7 lakh in the latest quarter. Okay, so this is the idea. So credit to the microfinance sector, where the small loans are given, increased for the first time after 7 quarters of decline towards the credit to the microfinance, but the borrower base has continued to shrink. Now, coming to the banking system. So, even as the banking system resilience remain intact, funding is emerging as a key challenge. A bank's liability profile is shifting from low cost current. See, basically, banks take the deposits, and from the collected deposits, the bank provide the loans. Now, previously, what was happening that there were more CASA deposits that were happening. That means current account, saving account. These deposits, for these deposits, there are less interest that have to be paid, 2%, 3%. While on the loans, the bank was getting the interest of 8% to 10%, let's say, on average. While now, the deposits are shifting away from CASA to term deposits. Now, the people are more interested to do the term deposits, where the interest rate is in between 5 to 7%. So you can understand that the profitability of the banks can reduce because there is the increase in term deposits rather than CASA. So this is the idea that there is the problem that is emerging in the funding. So funding is emerging as a key challenge. Bank's liability profile, that means the deposits that the bank is taking, that is the liability of the bank because the bank has to return the deposits. So bank's liability profile is shifting from low cost current and savings account to higher cost deposits and the certificate of deposits for which higher interest has to be paid, pushing up the cost of funds, for the banks. Okay? Banks are expanding the credit to higher yielding segments such as the MSMEs and retail, where the interest rate charged is higher, let's say 10%, 12% and such, which is helping to protect their margins. So banks are getting more of the term deposits for which banks have to give higher interest rate. So banks are giving more of the loans to MSME and retail segment where the banks earn higher interest also, so that the margins can be maintained. Okay? While some so now in the MSME segment, while some initial stress is visible in micro enterprises, the overall gross non-performing asset ratio has shown improvement. Similar asset quality trend is seen in the retail segment also, with the GNP ratios for the secured and unsecured retail loans lower at 0.7 and 1.7%. Okay? So MSME loan growth, here you can see overall there is the growth in the MSME sector for the loans. Okay, there is the MSME loan growth. For the retail segment also, here there is the growth for the retail segment also. So for the MSME and for the retail segment, there is the growth in the loans that are provided by the banks. And in both the categories, the gross non-performing asset has improved. That means it is reducing. GNPA is reducing. For the retail segment also, the asset quality has improved. For the secured loans, there is the gross non-performing asset of only 0.7%. For the unsecured loans, there is the gross non-performing asset of 1.7%. Okay? Cyber risk is increasingly recognized as a source of financial system vulnerability. And in the recent survey that has been done by the RBI, it has been found that while financial institutions have established robust practices in key areas of cyber risk management, AI-enabled cyber attacks emerged as the most important near-term challenge that has to be dealt with. Okay? Overall risk in the banking sector as indicating by the banking stability indicator. So there is a banking stability indicator. So overall risk in the banking sector as indicated by the banking stability indicator has reduced. So overall risk to the banking sector has reduced, supported by improvements in all dimensions except liquidity. So liquidity is the problem because the funding is the problem, as the CASA deposits are reducing, the low interest deposits are reducing, and the term deposits and the certificate of deposits, they are increasing, which has higher interest. Now coming to the NBFC sector. Any confusion, anyone? All clear? Now, NBFC sector continue to demonstrate resilience. Here you can see that there is the gross non-performing asset of 2.4% only, while the net interest margin is 5.1%. So this shows the interest margin, that is the interest earned minus the interest paid, and the net interest margin also shows the management of the assets. So interest earned minus interest paid against the asset management and such. Okay. The return on asset is 2.3%. So that is also good. And the CRAR is 24.6% for the NBFCs. So here you can see that the gross non-performing asset, it is quite less now. The net interest margin is good, return on asset is good, the CRAR is very, very good. Okay, NBFCs, their CRAR is 24.6%. So while overall credit growth moderated, lending to the retail segment has remained robust, driven largely by the sharp expansion in gold loan portfolio that now forms 17.4% of the NBFC's retail portfolio. So as the gold prices are increasing, there are more and more people that are taking the loan against their gold. Okay, so gold loans are increasing. So NBFC, while overall credit growth has moderated, has reduced slightly or moderated, the credit growth, so basically the growth is happening, but it is moderated. Lending to retail segment has remained robust, driven largely by the sharp expansion in the gold loans. The overall improvement in asset quality is evident as the gross non-performing asset is 2.4%, while the net non-performing asset has reached low of 0.8% for the NBFCs. NBFCs continue to play a very important role in financing the MSMEs and microfinance enterprises, supporting financial inclusion and employment. Overall risk in the NBFC sector is moderated, has seen a moderate increase. Okay, has seen a moderate increase. So overall risk in the NBFC sector, as indicated by the non-banking stability indicator, saw a moderate increase, reflecting a slight weakening in profitability and liquidity metrics. So profitability and in the liquidity metrics, there is slight weakening, due to which there is the slight increase in the non-banking fund. There is the slight increase in the overall risk. So overall risk in the NBFC sector, as indicated by the non-banking stability indicator, saw a moderate risk, reflecting a slight weakening in profitability and liquidity metrics. However, the NBSI remained below its long-term average. That means in comparison to the long term, the NBFCs are doing good right now. Okay. Corporate sector, now coming to the different sectors. So this is the end of the first chapter. So corporate sector, strong balance sheets of the non-financial corporate sector along with those of financial institutions. So financial institutions, non-financial corporates, they have strong balance sheet. Debt serviceability, so the corporate sector has good debt serviceability. That means whatever debt the corporate sector has taken, they have enough of the earnings to pay their interest. So that is seen through the interest coverage ratio. Interest coverage ratio shows that the corporates have sufficient earnings to cover their interest. Okay, so this is the idea. So the strong balance sheet of the non-financial corporate sector along with those of financial institutions, there are strong balance sheets. They have been the key pillar of the domestic financial stability. Debt serviceability, that means the corporates having the capacity to service the debt, to pay back their debt, to pay the interest, as measured by the interest coverage ratio, a key indicator of corporate sector vulnerability, has continued to improve. That means the interest coverage ratio has improved. The corporates have sufficient earnings to pay back their interest. So this measure has improved. Household sector's debt continues to trend upward, reaching 45.5% of GDP by end September 2025. So you can understand that 45.5% of the GDP, this is the household sector's debt. In terms of broad categories, those availed for consumption purpose account for nearly half, 49.7%, that is nearly half of the share in the household sector debt. In the household sector debt, nearly half is for the consumption purpose, then for asset creation, then for the productive purpose. While there is the growth in the consumption purpose, there is the growth that has happened in the loans. In the productive purpose also there was the growth. So consumption related loans, the primary driver of the household borrowings, followed by loans for productive purposes, they have grown, whereas borrowing for asset creation expanded at a relatively slower pace. So they have expanded by a lower pace. So this is the idea that the major chunk of the household debt is for consumption purposes, then for asset creation, and then for productive purposes. Now for the consumption purpose, there is a huge growth that was seen, and for the productive purpose, but for the asset creation, there is the asset creation loans have expanded, but at a relatively slower pace. This is the idea. Now consumer segment loans continue to be a key driver of credit growth. That we have seen that the consumer segment loans continue to be a key driver of the credit growth across banks and NBFCs. Gold loans have emerged as the largest segment within the non-housing retail loans. So in the retail loans, that is the loans taken by the households, loans taken by the individuals, the housing loan is the major chunk. Okay, Other than that, the gold loans have emerged as the largest segment within the non-housing retail loans. The gold loans have emerged as the largest segment. As the gold prices are increasing, there are more people that are taking the loan against their gold. So this is the idea. Gold loans are subject. Now these percentages are not very important. The percentage that is important is this, that the gold loans are subject to the loan to value ratio of 75% and 85%. That means against the gold value, against the collateral value, let's say gold value is 20 lakh rupees. The gold value is 20 lakh rupees. Against that, only 75% of loan that can be given. That is, or let's say loan is 10 lakh. So only 7.5 lakh of loan that can be given. So this is loan to value ratio. That is whatever is the collateral value. Against that, in the gold loans, in the gold loan, the collateral value is the gold value. Against that, the loan can be given 75% or maximum 85%. So this is the idea. Okay. So gold loans are subject to a loan to value cap between 75 to 85% based on the amount of gold loan borrowed. Among unsecured retail loans, personal loans dominated consumption related loans. So this is the idea. Now, last point that we have to discuss from this chapter is that fintech firms have strengthened their position in the small ticket personal loan segment. Here you can see that the growth in small ticket personal loans, that is of less than 50,000 rupees, driven by fintech firms. The highest growth is of fintech firms, that is 41.6%. Okay. Unsecured loans form about 70.5% of their total loan book. So there is chances of default, there is chances of problems also, because the unsecured loans are the majority of their total loan book in the small ticket loans segment, and around half of them were extended to borrowers under 35 years of age. So fintech firms, this is about them. Now coming to the chapter 2, where we will discuss the financial institutions, soundness and resilience. We will discuss about scheduled commercial banks, urban cooperative banks. We will discuss about the NBFCs and the mutual fund and the insurance companies. Chalo, let's get started. So we are starting with the scheduled commercial bank. Credit growth 14.5%, deposit growth 11.5%, asset quality GNPA 1.8%, NNPA 0.4%, slippage ratio 1.2%, PCR provisioning coverage ratio 75.4%. So these percentages we have already discussed in the previous slide, where we discussed about the scheduled commercial bank. Now liquidity coverage ratio 124.2%, net stability funding ratio, that means the funding that the banks are receiving, 122.1%. Net interest margin, this is the interest received minus interest paid. So 4% is the net interest income growth that has happened, interest received minus interest paid. Now this is for earnings. This is to see the earnings. Okay. So the overall from the operating growth, for the operating earnings growth, so this was 14.5%. So profit after tax 7.2%, the earnings before provisions and tax 7.9%, net interest margin, here also we see the net interest income divided by the asset management and such. So this shows the profitability. The net interest margin, see the net interest income, it shows the earnings. Net interest margin, it shows the profitability, that is against the assets, against the loans, what is the interest that has been earned against the interest that has been paid. Okay. So net interest margin is slightly lower than the net interest income to 3.3%. Return on asset 1.3%, return on equity 12.6%, common equity tier 1 ratio, that is the most liquid capital that the banks have, 15.3%, CRAR, that is the capital against the risky assets that the banks are holding, 17.7%. Okay. Now here the NIMs, that is the net interest margin, remained broadly stable during the financial year. Growth in earnings before provisions and tax. So in the earnings before provision and tax, there is the growth of 7.9% that has been seen. So the growth has moderated as the growth in other operating income. So this is the growth in other operating income lost some traction because before it was growing at 18%, now it is only growing at 14.5%. So because of the reduction in the growth of the other operating income, there is also the reduction in the earnings before provisions and tax. Okay, in case of ROE and ROA, return on equity and return on asset, public sector banks recorded a marginal improvement in both the ratios, whereas foreign banks witnessed some moderation, decrease in profitability ratios. Monetary policy easing. Now what is happening, that the repo rate was reduced, with that the interest rate, the lending rate also reduced for the banks. At the same time, with the reduction in repo rate, the standing deposit facility rate, that is the deposit rate of the RBI, was also reduced. So the banks also reduced their deposit rate. So banks are reducing their lending rate, the banks are reducing their deposit rate. Okay, so the net interest margin broadly remained unchanged because the lending rates were reduced by the banks, the borrowing rate was also reduced by the bank. But because of the higher credit volumes, that means more loans were given, growth in NII was seen at 4%. That was it is not a huge growth, but still a slight growth has been seen in the net interest income. Okay. Now deposit growth and share. So deposit growth was 11.5%. The highest share in the deposit growth, or we can say that the public sector banks have the highest share in the deposits, then the private sector banks, and then the foreign banks. The growth has been seen highest in the foreign banks. Okay. CASA and term deposits. Here you can see that the March 2026, the CASA, it has the growth of 10%. Okay, while the term deposits, it has the growth of 11.8%. Okay. Now coming to the next one, scheduled commercial bank credit growth accelerated to 14.5%. The highest growth, credit growth, was in public sector banks, then foreign banks. The share was also, the highest share in the credit growth was of the public sector banks. The percentages are not important, the share is important. That basically the percentages are not important for anything. It is important to remember that which has seen the highest growth in deposit case, it is the foreign banks, but the highest share is of public sector banks. Okay. In the term CASA and term deposits, the higher increase growth is of term deposits. Now for the credit also, same percentages are not important. Here only the overall percentage is important, but the growth is higher in public sector banks and the share is also higher of the public sector banks. Next, here you can see that the credit to the different sectors. So highest credit goes to service sector. The highest share of credit goes to service sector as well as to the retail, for the personal loans. So highest share of the loan goes for the service sector and the personal loan, and they have also improved slightly. Next is the personal loans. In the personal loan category, because a major chunk, like the highest share of loans are going from the banks, from the scheduled commercial bank, the highest chunk of loans are going for the personal loans. So basically personal loans, they are given mostly for what category? For the housing loans, okay, and other personal loans. The growth rate you can see in the housing loans was only 8.3%, while for the other personal loans 27.5%. Okay, the growth rate was highest here. The highest and lowest you can remember. The highest growth rate was in the other personal loans, while the lowest growth rate was in the housing loans. This is the idea. No, lowest growth rate was in the credit card receivables. That's it. Okay, so this is it from this point. Now moving forward, asset quality of the scheduled commercial bank has improved because the gross non-performing asset was 1.8%, while the net non-performing asset was 0.4%. The share in loans and GNPs. So the public sector banks, their share in loans is the highest and their share in GNPs is also the highest. Now, sector-wise GNPA ratio. So the highest gross non-performing asset is in agriculture, and the highest share of gross non-performing asset is also in the agriculture. So agriculture is having the highest GNPA ratio and highest share in GNPA also. So what you have to remember from here, that is what is the credit rate. Credit growth rate is 14.5%. The highest credit growth was in the public sector banks, and the highest share of the credit growth is also, or the credit, the highest share in the credit is also of the public sector banks. The other personal loans, in the personal loan category, the other personal loans had the highest growth, and the highest share is of the housing loans, and the other personal loans, in the personal loan category, the highest share is of housing loans and the other personal loan. Okay. Next is that the asset quality GNPA for the scheduled commercial bank 1.8%, NNPA 0.4%. The highest GNPA ratio is from the agriculture sector and the highest share of gross non-performing asset is agriculture sector. The annual slippage ratio is 1.2% and it was annual slippage ratio, that is the new loans that are becoming non-performing asset. So annual slippage ratio steadily moderated, reduced over the last 4 years. That means new loans, they are becoming less, like there are less new loans that are becoming NPA, so that is good for the country. The annual slippage ratio has steadily moderated, reduced over the last 4 financial years to 1.2% in 2025-26, driven by lower fresh accretions to impaired assets in public sector bank and private sector banks. So this is good that there is the annual slippage that has reduced. Okay, and it has moderated to 1.2%. Write-offs relative to gross non-performing asset remained elevated. Still, there are the write-off. Write-off means that the bank is considering that this loan is completely lost now. Now we will not be able to retrieve the money. So the banks write off such kind of gross non-performing asset from their balance sheet. Okay, so write-offs have remained elevated. So this is the problem. Now, annual slippage ratio, here you can see it has decreased to 1.2%. That is good. That means less of the new loans are becoming NPAs. Provisioning coverage ratio is 75.6%. That means for the gross non-performing assets, there are sufficient provisions that the banks are maintaining of 75.6%. Next is share of large borrowers and loans and GNPAs. So share of large borrowers in loans is 44.5%, while the share of large borrowers in GNPAs has reduced to 31.5%. Okay. So the share of large borrowers in loans is increasing, while the share of large borrowers in gross non-performing asset is decreasing. So that is good news for the country. Okay. A large borrower is defined as one who has total fund-based, non-fund-based exposure to the banking system of 5 crore and above with any bank. Scheduled commercial bank replenished their capital buffers, recording multi-decadal high capital to risk-weighted asset ratio. So CRAR is the capital against the risk-weighted assets. That means against the risky assets, the bank is maintaining the capital of 17.7%. This is the CRAR. The common equity tier 1 ratio, that is the most liquid capital that the bank is holding, is 15.3%. Okay. So 17.7% of the CRAR, while the 15.3% of the common equity tier 1 ratio. This we have discussed because it was in the first chapter also, it is in the second chapter also. Now coming to the tier 1 leverage ratio, that is basically the ratio of tier 1 capital, the most liquid capital that the bank has, divided by the total exposure. So the tier 1 leverage ratio has improved. That means the tier 1 capital against the total exposure has improved. Now coming to the macro stress test. Resilience macro stress test. See, macro stress test, these assesses the resilience of scheduled commercial bank to adverse macroeconomic shocks. It attempts to project capital ratios of banks under the baseline and to adverse macro scenarios. So basically, under the macro stress test, we see a baseline scenario, a normal scenario, while the baseline scenario was derived from the latest forecasted path of the macroeconomic variable. So baseline scenario is the normal scenario that we have assumed or we have forecasted. While the adverse scenario, there are two adverse scenarios, adverse scenario 1 and adverse scenario 2. These are the stress scenarios that if such kind of stress is coming, how the banking sector will react and what will be the data for the banking sector. So basically, baseline scenario is the normal scenario. Adverse scenario 1 is this scenario assumes further intensification of geopolitical risk, elevated energy prices to continue, exchange rate pressures to continue, leading to rise in domestic inflation, growth slowdown during 2026-27, followed by a gradual slow improvement in the situation during 2027-28. Adverse scenario 1 is this. Adverse scenario 2 assumes, this scenario assumes prolonged, more widespread geopolitical conflicts extending to 2027-28 also, leading to disruptions in domestic inflation and growth in both the years 2026-27, 2027-28 also. Okay? So adverse scenario 1 states that the problems will come in 2026-27, but in 2027-28 the things will improve. While the adverse scenario 2 is saying no, for 2 years let's say the problems are coming, then what will happen? Then the banks will be able to maintain good capital or not. Okay? So this is the adverse scenario 1, this is the adverse scenario 2. So the system level CRAR, the data is taken for a system of 46 select banks the macro stress test was done on the 46 select banks. So in the actual, for the 46 selected banks, the actual date of actual CRAR, actual capital against the risky assets, are 17.5% as on March 2026. That is for the financial year for 2025-2026. So that ended in March 2026. For that, the actual CRAR was 17.5% for the 46 select banks. Now it is said that in the baseline scenario, the CRAR is expected to be 15.6% by March 2028. Okay. While it is expected to be 13.3% in adverse scenario 1, and it is expected to be 13% in adverse scenario 2. So this is the idea. Any confusion? So system level CRAR is shown that what will be the data or what will be the capital sufficiency of the banks if there is the adverse scenario 1. In the baseline scenario, it is said that the projected capital that the banks will be holding is 15.6%, while for the adverse scenario 1, 13.3%, adverse scenario 2, 13%. So here you can see that at the bank level, no bank would breach the minimum CRAR requirement of 9%. So minimum CRA requirement is 9% plus 2.5% of the buffers that have to be maintained under the baseline scenario. While so this is the idea, while the banking system will be able to maintain more than 11.5% of the CRAR with the buffer requirements, but in the adverse scenario, one bank can breach this CRAR requirement of 9%. That means out of 46 banks, maybe one bank might not be able to maintain the CRAR. Two banks in the case of adverse scenario 2. So this is the idea, that under the baseline scenario, it is expected that no bank would breach the minimum CRAR requirement of 9%, while one and two banks may fall below the requirement under the adverse scenario 1. One bank under the adverse scenario 2, two banks may breach the 9% of the minimum CRAR requirement. Okay, but at the banking system level, it is seen that there is no expectation of the CRAR going below 11.5%. Now, common equity tier 1 capital, that is the most liquid capital that the banks have to maintain 5.5% plus the 2.5% of the buffers. So the minimum requirement of the common equity tier 1 capital is 5.5%. Currently, the banks are holding 46 select banks. For that, the data is given for March 2026. That is 15.2%. Now, till March 2028, it is expected to go down to 13.9%. In the baseline scenario, in the adverse scenario 1, 11.6%, in the baseline scenario 2, 11.4%. But here you can see that the 5.5% of the minimum common equity tier 1 ratio the banks will be able to maintain, as well as the 2.5% of the buffers also. So nonetheless, all the banks would continue to meet the minimum common equity tier 1 capital ratio requirement of 5.5% in all the scenarios. So we are expecting that the banks will be able to maintain good capital. Now coming to the gross non-performing asset, so it is expected that the gross non-performing asset will slightly increase in the baseline scenario from 1.8% to 1.9%, while it will increase to 3.8 to 4.1 in adverse scenario 1 and adverse scenario 2. Now, the resilience of the scheduled commercial bank was also checked for the credit risk, liquidity risk, and the other kind of risk in the 1 standard deviation, that is shock 1, and 2 standard deviation, that is shock 2. Now, so much of the data you will not be able to remember, so we are not going through all the different kind of risk and their data. That is not what you will be able to remember. So now moving forward with primary urban cooperative banks. Credit growth and share. So the credit growth was 9.6%. For the urban cooperative banks. In this, the scheduled urban cooperative banks have less share in comparison to non-scheduled urban cooperative banks. Okay? Non-scheduled urban cooperative banks have a higher share of the credit. Under the primary urban cooperative banks, it is non-scheduled primary urban cooperative banks that have higher share of the credit. Okay? The credit growth was higher in the scheduled urban cooperative banks. So this is the idea. Any confusion, anyone? So non-scheduled urban cooperative banks have a higher share of credit that they are providing, but it is the scheduled urban cooperative banks that have seen higher growth. Gross non-performing asset, so it was 5.2% for the primary urban cooperative banks, 1% for the 1% was the net non-performing asset. Okay, so gross non-performing asset 5.2%, while the net non-performing asset for the primary urban cooperative banks 1%. So this is the idea. Okay. While the gross non-performing asset as well as net non-performing asset was lower in the scheduled urban cooperative banks in comparison to non-scheduled urban cooperative banks. Coming to CRAR, CRAR is 17.7% for the primary urban cooperative bank. Just remember the overall data. 9.6% of the credit growth share is higher of the non-scheduled urban cooperative banks. The GNPA ratio of 5.2% and NPA ratio of 1%. The CRAR of 17.7%, provisioning coverage ratio of 97.8%. That means against the gross non-performing asset, the provisions that can cover the gross non-performing asset is 97.8%. Like nearly all the gross non-performing asset can be covered through the provisions that the urban cooperative banks are maintaining. So that's good. Okay. Next is net interest income 2.4%. So net interest income growth is by 2.4%, while the net interest margin growth is by 3.3%. Here basically net interest income shows the earnings, while the net interest margin shows the profitability. So the profitability is 3.3%. Return on asset 0.6%. Return on equity for the stakeholders, for the shareholders 6.3%. GNPA of large borrowers, the gross non-performing asset of the large borrowers 8.2%. 8.2%. This is the gross non-performing asset of the large borrowers. Now coming to the system level, see, the stress test was also done for the primary urban cooperative bank. Stress tests were conducted on a select set of urban cooperative banks to assess credit risk, market risk, liquidity risk based on their reported financial position as at the end of March 2026. Okay, so system level CRAR, you can understand that in case of credit default risk, in case of credit concentration risk, market risk, in any of these cases, in the case of baseline, medium stress, severe stress, but still good level of CRAR will be maintained, which will not like the minimum can be 13.9%, not lesser than that, even in the stress scenario. Okay, so this is the idea. Now coming to the next one, that is NBFCs, non-banking financial companies. So for the urban cooperative banks also, it is considered that the urban cooperative banks will be able to maintain more than the minimum capital requirement. Okay, so they will be able to maintain more than the minimum CRAR. So the urban cooperative banks will be able to maintain more than the minimum CRAR, even in the most stressful situation also. The percentages are not important in this particular case. The rest you have to remember. Okay, so I have provided you the diagrams, just the final percentages you have to remember. Now coming to the NBFCs, credit growth was 16.6% for the NBFCs are divided into 4 layers: base layer, middle layer, upper layer, and the top layer. The higher you go, the larger the size of the NBFC or the more riskier the NBFC is. Now the data is given for the upper layer and middle layer. Okay, for these 2 layers the data is given. So NBFCs upper layer and middle layer, the credit growth was 16.6%. The highest share is of NBFC middle layer in the credit by the NBFCs. Credit growth and share by activity. So the highest share of the credit is of the NBFC investment and credit company. So investment and credit company, they provide the highest share of credit in the NBFCs. Then it is NBFC infrastructure finance company, then NBFC microfinance institution, then NBFC infrastructure debt funds. Okay, now the growth, here you can see that there is the growth that has improved massively for the NBFC microfinance institutions, and for the NBFCs, like for the NBFC infrastructure debt fund, there is the improvement in the growth rate, in the credit growth. Any confusion here? All clear? Chalo. Moving forward, sectoral credit growth and share. Now here retail loans, they have the highest growth rate. After that agriculture, then services, and then the last industry. But the highest share of the loans were going to the industry, then the retail. Okay, so higher share of the loans going in the terms of activities, it is to the investment and credit company, then infrastructure finance company. In the share, the highest credit share to the sector, the highest share or in the loan category, it is going to the retail loans and then to the industry. Okay, so this is more important that you have to remember from the examination perspective. Chalo, next is sectoral asset quality and share. So here the industries, they have the highest, like they are getting the highest loans, as well as they are having the not sorry the industries, they are having the highest share in the credit. Then there is the retail loans that are getting the second highest. Okay, while in the case of gross non-performing asset, the highest share of the gross non-performing asset is in the retail loans. In the retail loans, highest gross non-performing asset share. Then it is in the industry. The percentages are not important. Again, here the percentages are not important. The shares are more important, because a question can come that out of these 5 loan categories, which has the highest share? Which has the highest share in the NBFC credit? So it is the industry. Which has the highest share in the NBFC GNPA? So it is the retail loans. Which loan has the highest share in the NBFC GNPA? So it is the retail loan. So this is what you have to remember. Okay, so within retail loans, growth was primarily driven by gold loans and other retail loans, whereas vehicle auto loans witnessed a slowdown. The net interest income growth year on year of NBFCs increased by 9.7% in March 2026. Profitability also improved as reflected in profit after tax growth of 11.8%. Okay, so this is the idea. Now, the growth in net interest income and the PAT was higher in the case of upper layer NBFCs. So this is the idea. So here, what you have to remember is the credit growth and share. So credit growth was 16.6%. The share, the highest share of the credit is with the NBFC middle layer. Then credit growth 22.3, then here the share is more important. That is the highest share in the credit growth, or in the highest share in the credit is NBFC ICC, then NBFC Infrastructure Finance Company. The highest share in the sectoral credit is of industry, then retail loans. The highest share in GNPA is of retail loans, then industry. Just switch it up. Now, profitability, as it has been said here also, the net interest income, the profit after tax, this has grown more for the upper layers. Okay, so net interest income, the profitability, it has increased more for the upper layer in comparison to middle layer, while the capital ratios are maintained more by the middle layer in comparison to upper layer. So profitability is higher in the upper layer, while the capital ratios is higher in the middle layer. That's it. Earnings of profitability. So earning and profitability data we have discussed. 9.7% of the net interest income. This is the growth. 11.8%. So net interest income growth year on year of NBFCs increased by 9.7%, while the profit after tax growth was 11.8%. This is it. And it was higher for the upper layer. It was higher for the upper layer. Now coming to the stress test. So system level stress test was conducted on a sample of 174 NBFCs over a 1-year horizon for assessing the resilience of the NBFC sector to credit risk shock. So here you can see in the baseline GNPA ratio, the CRAR is given, the number of NBFCs for which CRAR would decline below the regulatory requirement, that is given. So basically in the baseline scenario, the CRAR will be high, 2.8 will be the GNPA ratio, and 7% is 7 NBFCs are considered to have the CRAR below the regulatory minimum, which will increase to 15 NBFCs in case of medium and severe stress. Again, the numbers are not important, just the idea, overall basic idea is important in this particular case. So I have given you the idea that what kind of questions can come. Any confusion, anyone? Now coming to the mutual funds and insurance sector. So mutual fund, we have discussed the asset under management for the mutual funds have increased in the previous chapter. Now, stress testing of open-ended debt schemes of mutual fund. Basically, it was clearly stated that for mutual funds, the stress testing will only happen for the open-ended debt schemes. For the open-ended means you can enter in this mutual fund scheme whenever you want, you can exit whenever you want. So they are open-ended debt schemes. Number of asset management companies that can breach the thresholds. So numbers, again here also the numbers are not very important. The idea is that the stress testing for the mutual funds happen for the open-ended debt schemes. Now coming to the insurance sector. So if a question is coming regarding the different sectors, how they are performing, so I have given you the data for the banking sector, for the NBFCs. Then we are discussing the data for the insurance sector also. For the mutual funds also I have given you the asset under management data. Okay. So size and structure. So total premium income reached 13.3 lakh crore as of 31st March 2026, registering a growth of 11.7% over 2024-25. So there is the total premium income that has grown by 11.7%. Okay. The compounded annual growth rate from 2021-22 to 2025-26, that is in the 5-year time period, the compounded annual growth rate of the premium income was 9.9%. Now coming to the market share, the top 5 insurers in the life insurance segment, where there is the life insurance corporation, LIC and such are involved. So in the life insurance segment remains highly concentrated, with the top 5 insurers accounting for 81% of the total premium in 2025-26, while the general insurance sector, it is more diversified, with the top 5 insurance accounting for the top 5 insurance companies only accounting for 41% of the gross direct premium. So this is the idea that in the life insurance segment there is more concentration. The top 5 insurance companies, they are accounting for 81% of the total premiums collected, while in the general insurance sector there is more diversification. Now you must have heard about the solvency ratio. Solvency ratio in the insurance companies basically means that against their liabilities, because they are providing the insurance, the motor insurance, the fire insurance, the health insurance, the life insurance. So what they have liabilities, that what if that bike or the car against which the insurance was given, what if it gets into any accident, okay, or the health disease happens, or the health some operation is required. So this is the liability of the insurance companies. Against that, the insurance companies have to maintain the assets so that they can cover the future liabilities, the contingent liabilities. Okay. So against the future liabilities, the insurance companies have to maintain the assets. It is considered 150% that is required. So insurance companies have to maintain the 150% of assets against the liabilities. If the future liabilities are 100 rupees, minimum assets have to be 150 rupees. That has to be maintained. If the future liabilities are 200 rupees, so 150% of that is for 250, 300 rupees. Okay, 300 rupees are the assets that have to be maintained. That is the idea. Now in the life insurance, less than 150, solvency ratio of less than 150 is of no life insurance company. But in the general insurance category, there are 3 insurance companies that are having the solvency ratio of less than 150. Okay, so this is the idea. That's it. The higher solvency ratio, the insurance companies can have higher solvency ratio, but the minimum requirement is 150. Minimum requirement is 150. Life insurance companies, they are able to meet the minimum requirement, but the general insurance company, the general insurance companies, they are 3 general insurance companies, they are not. They have less than 150 of the solvency ratio. Now coming to the interconnectedness, so we are coming towards the end of the session. Just 2-3 more slides we have to cover. Just a few more slides. Okay, chalo. Interconnectedness. So financial system can be visualized as a network. So financial system can be visualized as the network, where financial institutions, they are the nodes that are connected through the loans or the exposure that they have with each other. Okay, so financial system can be visualized as a network where financial institutions act as nodes, and the bilateral exposures among them serve as link. Bank A has given loan to Bank B. Bank B has given loan to NBFC. Bank B has deposited some money in the Bank A. Bank B has lent to Bank C. So basically there are the bilateral exposures. These links could be in the form of loans to, investments in, or deposits with each other, which act as a source of funding, liquidity, investment, and risk diversification. So financial institutions, they are linked with each other. Now the network analysis covers 280 financial entities in the country. Total outstanding bilateral exposure of the 280 entities expanded by 20.1%. So total bilateral exposures have increased by 20.1% as on March 2026. Now share of different groups. So the scheduled commercial bank have the highest share in the bilateral exposures, then the NBFCs, after that the All India Financial Institutions. Okay. After that, there is asset management company, mutual funds and such. Now, coming to the next part. So, remember that the total bilateral exposures, they have expanded by 20.1%. They have the growth of 20.1%. And the share of different groups. The banks, the scheduled commercial bank, they have the highest share in the exposures. Next is instrument-wise exposure among entities in the financial system. Okay, instrument wise exposure. So the highest exposure is through the loans and advances. After that, it is through capital or equity investment. So highest exposure is through, like between the financial instruments, the highest exposure is of the scheduled commercial banks. It is through the loans and advances, then capital and equity investments and such. So this is the idea. Chalo. I hope this is clear. Then the rest of the diagram you can read, but the highest two categories you can remember. The share of different groups, the highest share of in the bilateral exposure is of the banks, then the NBFCs. In the category of the instrument wise exposure, so it is the highest exposure is through the loans and advances, and then the capital and equity investment. Now, the network model used in the analysis has been developed by Professor Sherry Marcose and Dr. Simon Gyansate. So this network model, it has been developed. Basically, the network model, the network analysis, it was developed by the Professor Sherry Marcose and Dr. Simon Gyansate. So this is it. Now, interbank exposures, between the banks, the exposures as a percentage of the total asset of the banking system edged up over the last 2 quarters and stood at 3.4%. Contribution of public sector banks being the highest. Contagion analysis, let's say if one bank is failing, what will happen to the other banks? If one financial institution is failing, then what will happen to the others? So this is the idea. Contagion analysis uses network technology to estimate the systemic importance of different financial institutions. The failure of a bank due to solvency and or liquidity losses could lead to contagion impact on the banking system if one major bank is failing. So how it will affect the other banks along with the financial system. So contagion analysis of the banking network as at the end of March 2026 position indicated that if the bank with the maximum capacity to cause contagion losses had failed. So if the bank 1, that is the bank with the maximum capacity to cause contagion losses has failed, it would cause a solvency loss of 2.2% of the tier 1 capital. That means the loss of tier 1 capital of the banking system will be 2.2%. 2.2% of the tier 1 capital will be lost in the banking system. For the banking system, liquidity losses as per the high quality liquid asset percentage, 0.7% of the liquidity losses will happen to the banking system, and one bank can additionally default due to liquidity. So if the bank 1 is failing, so this will be the problem that will be created. If the bank 2, let's say if there is the bank 2 that is failing, it has the capacity to cause contagion loss, so it will create some loss in the tier 1 capital and the liquidity of the banking system, but it will not create any default of the bank. Okay. Now, coming to the NBFCs and the non-housing finance companies continue to be among the largest borrowers of funds to the financial system. So the non-housing finance companies, the NBFCs and the housing finance companies, they continue to be amongst the largest borrowers of funds to the financial system, with a substantial part of funding from the banks. Okay, substantial part of funding from the banks. Now, contagion losses due to NBFC failure. So yes, tier 1 capital will be lost for the banking system if the NBFC 1 is failing, but the banks will not default. Similarly, if the housing finance company is failing, so yes, tier 1 capital of the banking system will be lost, but the banks will not fail. Okay, they will not default directly. Coming to the chapter 3, it talks about the regulatory initiatives in the financial sector. Now I have not brought the global regulatory initiatives. I can discuss that in a separate session. They were not very important. So global regulatory initiatives I have not brought, but we have the domestic regulatory initiatives. So basically the financial stability report is released for the past 6 months. Okay, for the 6-month time period. Now financial stability report is released for the 6-month time period. So in the past 6 months there are various domestic regulatory initiatives that have taken place that we have discussed also. If you have studied for the phase 1, like if you have studied for the phase 1 of the RBI Grade B examination, then you have gone through all these articles that we are going to discuss. If you have not studied this, let's say you are preparing for the next year, then right now you just have to get the basic idea. You don't have to go through all of these initiatives. The December 2026 report, it will be more the FSR December 2026 report that will be released, that will be more important for the students that are preparing for 2027. Okay, so if you are preparing for 2026 phase 2 of the RBI Grade B examination, you have already gone through these initiatives that have been taken by the domestic regulators for your phase 1. If you are preparing for the 2027 phase 1 and phase 2, then you have to focus on the financial stability report that is of December 2026. Okay. So this financial stability report is not very important for you. You have to focus on the next edition. For the students that have the examination coming this month only, for them, yes, this report is important. Domestic regulatory initiatives, risk-based premium framework for deposit insurance in India, where we discussed that the banks are divided into 3 categories and the category 1 has the highest discount rate. Okay? So previously there was a flat rate of 12 paise per 100 rupees was taken, but now there is the risk-based premium. Insurance premium is taken on the risk basis. Investments by foreign portfolio investors in debt securities, there were percentages that was given, that is for the central government security 6%, state government security 2%. This is the limit for the foreign portfolio investors. As well as it has been said that through the FAR, through the fully automatic route, there will be more securities, government securities that will be introduced or that has been introduced. Okay, so this we have discussed in the marathon session. This we have discussed in the Finance 360. These articles we have discussed in Finance 360 or in the marathon session for the phase 1. Swap facility for foreign currency, as I was telling you that in June itself, that is a few days ago only, we have discussed this in Finance 360, that there is the swap facility for foreign currency, non-resident accounts, banks, deposits. Okay, directions. So swap facility has been brought. As well as there is directions on asset classification, provisioning, income recognition for commercial banks. This we have discussed in detail in Finance 360-degree session. Open position for authorized dealers. So net open position for the authorized dealer should not be more than $100 million by the end of the day. Unique identifiers in financial market directions. The legal entity identifier, the unique transaction identifier we have discussed. Reserve Bank of India commercial bank capital charge, that is the risk weights are now decided by the Reserve Bank of India. So there is the standardized approach for the risk weight for the different exposures. They have different risk that is decided by RBI for all the banks, for the different banks. Okay, so this we have discussed in the marathon session in detail. Reporting of related party transaction by authorized dealer category 1 banks. So these all are the initiatives taken by the RBI. Now, the single window automatic and generalized access for trusted foreign investors, Swagat FI framework, this was introduced by SEBI. A verified label for stock trading apps for brokers registered with SEBI on Google Play Store. So the SEBI check, the validation, the verified. So all of this we have discussed. Okay. Then Project Sudarshan, AI driven fraud detection. So these are the initiatives by the SEBI. These are the 3 initiatives by the SEBI, 3 major initiatives by the SEBI. Now, the number of complaints received by the Offices of Reserve Bank of India Ombudsman for the previous 2 quarters indicate the majority of the complaints are related to the loans or advances and credit cards, constituting nearly 50% of the complaints during the last 2 quarters of the 2025-26. Now, these initiatives, if you are giving phase 2, then you must know about these. We have discussed these in Finance 360-degree sessions in your documents also that you are reading for the phase 2 from any of the course that you have these material. Okay. So these are the domestic regulatory initiatives taken in the past 6 months. So major initiatives you have to focus on. A question can come, a descriptive question can come on this. Now coming to deposit insurance, all the banks operating in India, they get all the banks. The depositors of all the banks operating in India, they get the Deposit Insurance and Credit Guarantee Corporation cover. So DICGC extends insurance cover to depositors of all the banks operating in India. Currently, DICGC, the number of banks registered with the DICGC was 1,950. With a present deposit insurance limit of 5 lakh, so that means your deposits of up to 5 lakh, they are insured by the DICGC, 97.4% of the total number of deposit accounts. With a present deposit insurance limit of 5 lakh, your deposits up to 5 lakh, they are insured. 97.4% of the total number of deposit accounts, they are fully insured. 39.7% of the total value of the accessible deposits are insured. So 97.4% of the deposit accounts are insured, while 39.7% of the value of all accessible deposits, they are insured. Okay? The amount that is insured is up to 5 lakh only. If you are keeping 10 lakh in your account, then only up to 5 lakh the insurance is provided by the DICGC. The insured deposit ratio was higher for cooperative banks, followed by commercial banks and such. Deposit insurance premium received by the DICGC grew by 14.1%. Commercial banks had a share of 95.1% in the insurance premium. So now the depositor insurance fund with the depositor insurance fund, this is the fund with the DICGC that is primarily built out of the premium paid by the insured banks, because the insured banks, they have to pay a premium to the DICGC so that the DICGC can provide them the insurance coverage, to the depositors of the insured bank. Okay? DIF recorded a 14.4% year-on-year increase. Now, corporate insolvency resolution process, it came into force with effect from December 1, 2016. This is important, that since the provisions of corporate insolvency means that the corporate is unable to pay back the loans. Okay? So now if the company is insolvent, that means it is not able to pay back its loans, then it can go into the bankruptcy process. That means either the liquidation of assets will happen, or the revival can be seen, the resolution process can be seen. So since the provisions of corporate insolvency resolution process have come into force with effect from December 1, 2016. That's it. Chalo. Now this is the final. This was given in the highlights in the financial stability report. Despite repeated shocks, the global financial system has thus far demonstrated notable resilience, with markets remaining orderly after an initial bout of the volatility followed by the outbreak of the West Asia crisis. Such kind of statement can come, and then you will have to inform about that. So in the initial 2 slides, we have discussed about the global economy. The global financial stability risk remain elevated. Persistent supply chain uncertainties could tighten the financial conditions, revive inflationary pressure. Meanwhile, elevated public debt, bond market fragilities that we have discussed, stressed asset valuations, leveraged NBFIs. NBFIs, non-banking financial institutions. So as the NBFI sector continues to expand, growing at double the pace of the banking sector, their rising footprint across the assets classes, their rising footprint in the bond market, in the equity market, so their footprint or their investment is increasing in the government securities, in the corporate securities, in the asset so in the derivatives, in the different securities, in the different asset classes, their investment or their footprint or their involvement is increasing. Okay, so NBFI sector continues to expand, growing at double the pace of the banking sector. Their rising footprint, their rising contribution, or their rising involvement across the different asset classes, the government security, state government security, central government security, corporate debt, the derivatives, the equity or the shares, heightens the risk of risk amplification. Because think about it, that if the stock prices are decreasing, okay, now because of the decrease in stock prices, the non-banking financial institutions, because they are non-banks, so they are mostly focused on their profit, so they also start taking out the money from the stock market. The stock prices are already decreasing. Now they also start selling their stocks, so the prices will further decrease, and the turmoil in the market can convert into financial instability. So this is what has been said, that because the non-bank financial institutions, they are growing very rapidly, So their contribution in the asset classes is increasing, and with more contribution by them, with more involvement by them, the NBFI, let's say there is some turmoil in the financial market, there is some turmoil, or in a particular market there is a turmoil and the stock prices are decreasing, or there is the turmoil in the stock market. So NBFIs might start taking out their money because they do not want the further they do not want to have losses because of the decrease in stock prices. So they take out the money. So there is more supply of shares in the market and they are selling the shares, so there is more supply of shares, so price will further reduce. So it will lead to financial instability. So this is the idea that because there is too much involvement that the NBFIs are having in the asset classes, this heightens the risk of shock amplification, and turning market turmoil into financial instability. Highly leveraged, that means the NBFIs, non-banking financial institutions, they take a lot of debt and using this loan money, they invest in the different markets. So they are highly leveraged. Quantitative investments, they focus on quantitative investment strategies, that is solely focused on profit in the short term, or the profit, they are mostly focused on the profit by the NBFIs, have the potential to cause volatility in the funding markets, core bond markets, and the equity derivative markets also. So this is the idea. Now the private credit, another form of NBFI, private credit, another form of NBFI. So NBFI are providing private credit. This has expanded notably in the recent years. Estimates vary about the size of private credit market, ranging from $1.5 trillion to $2 trillion due to differing definition across jurisdiction. Now this is about the global financial stability. In India, the private credit might not be allowed. Only the NBFCs and the banks, if they are providing credit, they need to be regulated by the RBI, they need to be registered, or they need to have the license from the RBI. But in the global market, there are the private credit that is being provided by the non-banking financial institutions at the global level. This has expanded notably, and estimates vary about the size of the private credit market, ranging from $1.5 trillion to $2 trillion. So this is the idea. So this is the leveraged NBFIs remain key vulnerabilities that could amplify future shock. All the points we have discussed that you can read. This is just the summary. So the balance of risk has turned favorable. Supported by the interim peace deal and such, domestic financial system remains resilient, underpinned by the strong bank and non-bank balance sheet. Scheduled commercial bank remain healthy, safe and sound. There, even in the stress situations, they will be good. Macro stress test has been done. This indicates that the banking system remains well positioned to absorb the potential shock, with aggregate capital ratios projected to remain comfortably above the regulatory threshold. NBFCs remains financially sound, as well as the insurance sector continues to display balance sheet resilience, with the solvency ratio of the life insurance companies remaining above the minimum threshold for all the life insurance companies, while in the general insurance category, there are 3 insurance companies that are in the below the solvency ratio threshold. Okay? India's sound macroeconomic fundamental place it in the stronger position than many of the peers. So this is the idea. So this is it. Now you have to tell me that in the comment section below, do tell me that do you want me to take a MCQ session for this FSR, and do you want me to bring the tables so that you have the data points at one place? Do you want such a session for the MCQs? So do tell me in the comment section below if you want such a session. I will bring a MCQ session. But if you feel that okay, there is no requirement for the MCQs, we will discuss the MCQs directly in the marathon session then. So do you want a MCQ session separately, or do you want me to take the questions in the marathon session directly? So just tell me in the comment section below, okay? Chalo. Then any confusion, anyone? Kindly ask me if there is any confusion. All clear? Any confusion, anyone? No confusion? Okay, then I will be closing the session. One point was for the primary urban cooperative banks. I have told you that even in the stress situation, even in the medium stress situation, the urban cooperative banks will be able to maintain more than minimum CRAR requirement. Okay. So that is there. Chalo. Then we have discussed the rest. This is it. The FSR report is done from my end. Thank you everyone. Do tell me that you want a separate MCQ session or do you want me to take the MCQs in the marathon itself. So this is it for today. Thank you everyone. I hope you understood. If there is any confusion, you can ask me in the comment section below.